So the existing rules that were there beforehand. So if you had a property before 9th of May 2017 and you're claiming depreciation on your curtains and carpets and so forth, yes, they are grandfathered. So the report that you would have had in place from BMT, as an example, then that just carries forward to claim every year thereafter. So you're still entitled to claim as long as the property was purchased before the 9th of May 2017 to be rented. So I mentioned there about you can go back and amend the last 2 years' tax returns. So if you haven't got one already leading up to 2020, then definitely inquire through a BMT organisation in regards to getting one. As I said, it doesn't cost you anything to inquire. And then if it is worthwhile, then your accountant can go back and amend, certainly at least the last 2 years. You can actually possibly apply to the ATO and get a 4-year window of amended returns done. The automatic's only going to be 2 years, but you can actually get a 4-year window, but you've got to appeal to get the extra 2. It's just a long delay, but if you're talking an extra couple of grand each year, then it's worthwhile doing that process.
Awesome. And Alan, you've got a deal for our landlords?
Yeah, so with the Rayner Group, as long as you mention that you were referred by them, you'll get the reduced fee of $7.15, including GST for the report. So it's basically $55 off the normal fee just for mentioning their name. And the fee for the report itself is a tax deduction. So Brent might pull me up if I'm wording this wrong, but I believe it's considered an expense relating to managing your tax affairs. So he can claim that much the same way your accountant, you can claim your accounting fees. So,
correct.
We've just got another question. It says, do you need the report if you're only a landlord for 6 months?
If you're only a landlord for 6 months, so therefore you'd only be able to pro-rata the report claim. So if let's just say you've had it, October through to March, you've had the property rented, well then it's going to be pro-rated that claim. You're not going to get the claim for the whole 12 months. So it's just a matter of going to the yearly summary page of the BMT report and I'll say the 2 different areas that you're entitled to claim for depreciation. Then you just got to pro-rata it based on the number of days of ownership that it's been that's actually been rented. So the actual tax department have got clever now with their tax return lodgements, and a lot of the taxpayers, the clients, that have no idea what goes into a schedule most of the time. But the last few years, the ATO have now made us answer a question that says the number of weeks the property has been available for rented, and then also the number of weeks it was rented. So the number of weeks it has been available and the number of weeks it was rented. Now, those dates or those number of weeks can be totally different because you're entitled to claim, whether it's depreciation, repairs, interest, etc., on your property, as long as it was available for rent. Okay. Right, so that's a very big key that you've got to understand too when you go to your accountant, because you want to maximise your deductions. So as long as it's available for rent, then you can claim, even though it might have taken you 6 weeks to get a tenant. It's not when the tenant moves in for you to claim the interest on your loan or the depreciation, etc.
And what, if any, is the difference if property is privately owned or with a SMSF? That's another question.
No, self-managed super funds can actually get these depreciation reports as well. We've got, 70 odd self-managed super funds that our firm does. And just about everybody that would have a rental property with it. Now, you got to remember these properties or these depreciation claims, guys, I sort of mentioned at the start, they're just not residential properties either. They are available for commercials, correct, Alan?
Yeah, I did a report on this hemisphere's largest solar farm late last year, so we do everything.
Yeah, so they are available for commercial properties. So a lot of people have, say, their existing factory that they may operate in their business from through a self-managed super fund. So they can certainly still obtain this depreciation report and get a tax deduction through their super fund. It just becomes a normal deduction, just like cancel rates or insurance.
And just jumping back to our last question, when you've got available for rent, when you said available for rent, does this mean on the market for lease, or if the house is vacated? ready to be
Yeah,
leased.
you've got to justify. So if you happen to get an order at the ATO's end, then you've got to justify as to how you had it available for rent. So, in the perfect world, without talking out of school, I'd say make sure you get your property listed at Rainers. So at least it's on their books as being available for rent, and you just couldn't get a tenant. So otherwise, if you put up just a docket on the notice board, say at the local IGA supermarket, well, and you're trying to says, property available for rent. Well, you got to prove the tax man that you actually really had that docket up there. Whereas at least through a real estate agent, it's going to be probably listed, Leanne, as soon as you actually, I come in and list it with you, there's probably going to be a date. So then that supports your ATO claim. Just don't think that if you're going to try to, available for rent yourself, then you've really got to have justification as to how you've really gone about to get that available. It's
So
easy to
if you
get it
had
through a real estate agent.
So if you had a house, say you had a house that you moved out of, or you had family move out of, and you did some work to it prior to actually advertising it for lease, that period that it's
No
empty.
go.
Yeah.
No go.
Yeah.
Right. So that otherwise you've got to justify to the tax department if you're doing renovations to the property, was it realistically available to the general public at large to rent? Whereas if you've gutted the whole place and taken the kitchen out and doing a new bathroom, well, it's going to be pretty hard to justify that you're realistically going to get a tenant. Whereas if you've just put an extension maybe on the back and it's still livable inside for a family to live in, then you could probably still justify it was available for rent.
Okay.
Just a question, Alan. We're coming up to the 30th of June now. What's the lead time if we ring you guys to do a report? Are you still being able to fit us in? Do we need to have it by the end of the financial year, Brent?
No.
No. Okay.
It's a common question this time of year. Probably the big thing, or it may or may not be a big thing, but as long as you pay for the report before June 30, you could time the expense of that so you could claim the fee back quickly and you're not sitting on that expense of $700 for a year. But the report will always be backdated. So even if we finish the report in July and you're going to sit down with Brent and do your return in August,
yeah,
you're not going to miss out on anything. So
yeah, great. That's good. Yeah, good to know. That's good. Just going back to just for the novices around, can you just quickly give an indication, Brent, on what depreciation actually is? Because I think we've got a lot of first-time investors that just buy an investment property thinking it's a great investment, but may actually not know much about depreciation and what it actually is. Can you just quickly go over that? Yeah.
So basically, depreciation is a book entry. So once you get the report, it's not like you're paying for council rates or insurances every year where you physically have to pay for it out of your bank account. It's what I call a book entry as a tax deduction. And basically, it's devaluation or wear and tear on the actual property and its assets, i.e. on the stove, on the carpets that you put down, on the curtains, that the value of them, if you've got a new stove today for $2,000, well, you claim depreciation on $2,000. In 5 years' time, it's not going to be worth $2,000. Even if you didn't even claim anything, if you had to pull it out, well, it might be worth $300 for somebody. So it's for devaluation of that item and wear and tear. And it's the same for the building itself, the capital works. You get a cost for that, as I said, the slabs of the concrete, the bricks. So basically, it's wear and tear on the actual property.
Yeah, great. And Alan, what on average would you find investors, like how much money on average would you think they'd get back from your report?
Kind of tricky
to
answer.
How long's a piece of string? I get that, but it's well worth it, isn't it? If you can have this report,
Look, if it's a brand new property, I think the average deduction's around $9,500 in the first year. If it was an older property that had a renovation, so if it had kitchen and a couple of bathrooms done, your annual deduction, if you haven't done the works yourself and you're only claiming on the structural stuff, because with those changes, you can still claim on the structure. You might be looking anywhere from $2,000 a year to $4,000 a year. I did one in Melbourne the other day, and the lady rang and said, "Oh, I got told it's not worth it anymore because the laws have changed." And it was an 8-year-old unit, and the annual structural claim was still 10 grand a year. So I guess for houses and stuff around your area or townhouses or whatever it may be, I would say with a second-hand property, anywhere from $3,000 to $5,000 a year.
Yeah, I think people, when they talk about depreciation, have this pie in the sky figure that they're not quite sure. Oh, it's probably not worth it, or But I think when you're talking thousands of dollars, especially during this time that landlords may have had trouble with tenants not paying as much rent as they normally would, all that, like anything in your pocket is a good thing to be claiming for sure.
We've got 2 more questions.
Hang on, can I just an extension of that? Sorry,
Yep.
Darren. I've just brought up my report that I've got from BMT for a rental property that I got in 2011. So it's 9-year-old, and I brought on the 10th of May 2011. And for my first tax year, I got a tax deduction for $2,936. So if you said I save a third of that in tax, depending on your tax rate, 2012, my claim was $7,670. Now in 2020, I'm still getting a tax deduction for $2,754. So I'm getting a third of that $2,700 still. So there's $900, and I've had it for 9 years, and I'm still getting a good tax deduction. That sort of property here in Bacchus Marsh that I bought 10 years ago.
Absolutely.
So they are worthwhile.
Okay, so I've got, is it more or less important to have a report for a property purchased and rented prior to May 2017, or is it just as important?
Well, it's if you've got a property that you had rented prior to May 2017, well, then it's a no-brainer that you should have had that already in place. So it's important that you speak to a BMT, but remember you can only go back and amend 2 years. You can object to try to get 4 years. So it was a no-brainer to get the reports done prior to May 2017 because you had both options to claim, the capital works as well as the actual curtains and carpets itself. Whereas post 2017, the major claim that you're going to get, Ellen, is the depreciation on the building, isn't it? Capital works until you actually replace the stove.
Yeah, correct. So I think historically the capital works, which that hasn't changed your ability to claim that. I think that generally, if I'm giving someone an estimate over the phone, I usually allow about 80% of the total build cost as capital works. That's being pretty conservative. I think most of the time it's more like 85%. So yeah, that's sort of all you're looking at post 9th of May.
But certainly you can speak to BMT, and Alan said that they go back to when you actually purchased the property, Alan, don't you, to get that report done?
Mm-hmm.
So even though it hasn't been, you may not have inquired about one, you've had it for 7 years, it's still worthwhile getting that report done. Because if you had it prior to May 2017, you can still get that 2 deductions as such. So you've just missed out on some tax deductions. That's all.
How does it affect your return if you don't have a report? Does it mean you can't claim depreciation?
Yeah. So if I go back, as I said, I've been 34 years doing this. 20 years ago or so, us accountants used to be able to pluck out a figure, and we used to just call it on the depreciation schedule called chattels, and that would be a so-called figure to cover your curtains and carpets and so forth. And let's just say it was $10,000 as a claim for all those items. But nowadays, no report, no claim. Unless you actually physically replace the items. So when you've brought the new stove or curtains, then as long as you've got the receipt, then you can definitely claim depreciation on them. But if you want to claim what's already in there, you're out of luck.
There's a few more. They're coming in hot and fast now. Is there a loophole when you say available for rent, i.e. kitchen renovations happening are now, but prospective tenants want to secure the property now?
Well, it's got to be available for rent. So if they're not going to be paying rent, it's going to be pretty hard to justify that it was available. So all that they're doing is just trying to pay a holding deposit, a holding fee, if you want to call it, for them to have access to that property so it doesn't get rented to somebody else that's not available for rent.
Okay.